Good afternoon and welcome to this edition of Marketing Webinar for Grain Farmers of Ontario. My name is Marty Hibbs and I'll be your host for the next 45 minutes to an hour. And as we mentioned before, most of these lessons will be archived in case you want to follow back at an earlier or a later time and you can catch up on them. We're hoping to cover a bit of ground today. To begin with, we're going to look at the pool, which we didn't really clarify the last time we spoke. I want to explain a little bit more about the pool. Then we'll move on to futures contracts defined. The market participants, because there are a few different market participants, and without them, this market wouldn't work. And then I'm going to walk you through opening an account with a brokerage firm or an account on your own, and we'll discuss margin. So that's quite a bit to cover today. And we can get started. Now, what I'd like to do before I go is if you have any questions, I'd like you to take advantage of write them in the box because it's hard for me to interact with you. I don't see you as a person. And when I'm dealing with individual people, they put their hand up or they stop me halfway through. So I'm not sure if you're getting the gist of what I'm saying. So please don't be shy. If you have any questions, by all means, type them in the box and we'll get around to them. The only thing I do request is that you keep them on topic. We don't want to be talking about options while we're dealing with futures. So having said that, let's just move ahead. The pool is something that Grain Farmers of Ontario offer for our farmer members. Now the pool, I like to look at it as another part of your marketing strategy. The pool is not necessarily something that you would put all your wheat in and walk away. But as some people do forward contracting, some do cash sales, some do futures contracts, you should possibly consider pooling some of your wheat or a percentage of it, especially if the market is down as it is right now, because the beauty of the pool is that we can market it throughout the year and hopefully get a better price throughout the year than you would at harvest when most of the pressure is in the market. So looking at the pool, the wheat is delivered to a GFO agent or terminal, and it's marketed throughout the crop year. As a producer, you'll receive an initial payment of approximately 65%. And of course, that depends on what the initial payout is, but generally it's about 65%. So you're getting the bulk of your money up front, and then that would allow you to be able to rest on the other 35%. And hopefully the bottom line is that you would do at least the average or possibly make a bit more, especially if the market behaves and moves the way that we anticipated would. Terminal delivery or a processor will result in an initial payment being sent from GFO, but the producers taking your wheat to one of our agents will be paid directly by the agent. So that's just a bit of difference there as far as how the payment is perceived. Of course, all expenses come out of there as well. Once the initial payment is received by you, we will have two more payments coming due, one close to the end of January, which is an interim payment, and that will show up before the end of January. And our final payment is at the end of our crop year, or our fiscal year, I should say, which will be in June. But by the time it's processed, it's usually by the middle to the end of August that you'll receive your final payment for the pool. Some of the rules for the pool, it runs from June 1st to September 30th as far as a contribution. That means that you need to deliver the wheat to the pool before the 30th of September. Deliver to an agent or a terminal. Again, as we said, we have a lot of agents in the area and we can give you a list of them that you can bring them to. These are delivered, meaning that the cost is incurred by you to deliver it to the agent and any handling fees. They will pay you the initial payment, which is set. And from there, you'll get the interim payment in January and the final payment in August. Now, a portion of it, a lot of people choose to go into the marketplace, not putting all their wheat in this pool. But if you put wheat in under the name of GFO at one of our agents between June and September without a contract, it's important to know that will automatically go in the pool. So make sure if you're delivering wheat on behalf of GFO, regardless of where it is, that you have a contract in place, unless you're planning on putting it in the pool. Because if you don't have a contract, it will end up in the pool. And one more thing is that sample wheat is not accepted by GFO in the pool. Okay? So if you have any questions about that, you can go ahead and write us in the line available for you to type in, but I think that generally covers the pool. So some of the pros we're looking at is that you're transferring your marketing skills to us, which means that because Todd and myself do this on a daily basis, we have opportunities sometimes to get a better price than you may. The pro is the initial payment, which is the bulk of the payment up front. There's no set quantity. So if you want, you can, a truckload, 40 tons, you can bring one truckload in and put it in the pool. And there is the potential for better prices because with the strategies that we use, if we were to get a better price in the spring, then you might do better than you had sold it in the fall or in the summer when it comes off the crop, off the ground. Some of the cons, there's only a few, of course, is a deferred final payment. You don't get it until the following August, but don't forget, it's only about 10 or 15%. So it's not a big inconvenience. And the other thing is it tends to average toward an average price. So you're not going to make a moonshot on this by putting it in the pool. But this year, I think everybody was quite happy because we got a good price over the year. We've marketed. And where wheat is now sitting down around $4.40 US, looked like it was a no-brainer to put some in the pool. Okay, let's get into the futures markets. This is the part we've been talking about, and I've been briefly mentioning a few things about it, but we're going to take it a bit deeper now and go a bit more into detail. And again, this is for everybody, so you may find some of it a bit redundant if you've traded futures before. And you might pick up a few tips even if you have done it. As I said before, I've done it for about 30 years, and I was in the business for 25 plus years doing this on a daily basis. So there's a bit to it, but I think most people, most farmers can utilize these markets, and we'll explain a little bit more about them as we go forward. The futures market's true purpose. This is one big thing that I get a lot of times. A lot of people talk about the futures market as being very risky. Oh, you can lose your house or whatever. The futures market is generally not really there for gambling. The futures market has a true purpose, and that is for hedging. We've talked about this before. Any major company that deals with raw materials has a reason to possibly use futures markets to remove the risk from what they are doing. Okay, so for example, some may look to lock in raw material prices for future use. So in the case of somebody like a trucking company, they may want to lock in the price for their fuel going ahead 6 months. Why? Because they take that out of the equation. And if they get a sudden spike in the price of fuel, then they're not going to get hurt because what they end up paying in the fuel costs going forward, they would make on their futures position. Some others like to lock in raw material prices to ensure profitability. So in the case of a farmer, if you see a price that you really like come August in the soybeans, but your beans are still in the ground, you might lock in that price in the futures market to ensure your profitability. And at that point, all you need to do is once you actually harvest your product and bring it to market, you will get basically the price that you've locked in. If the price moves a lot higher, you won't make any more because what's happening is you're losing on your futures, but you're making it on your physical, okay? But again, it's not a gambling situation. What you're trying to do here is just the opposite. You're looking to take the risk out of these markets, and by doing that, you're ensuring your price, but it kind of takes away the incentive to be able to make any more money on the amount that you've locked in. I hope that makes sense. And then, of course, locking in raw material prices to reduce your risk. Again, just like we said, if the prices start to sink, and give you a round number. Let's say your cost of production for soybeans is at $8. We get down to $8.50. Now we're talking U.S. futures markets here. You're concerned now that we're going to go in the red. So what you might want to do is lock in a price that you're not going to actually lose money on your crop. So it's not the best way to do it, but there is a case where you might want to consider that, especially this year where the soybeans have gotten hit so bad. And then on the charts, technically, they still don't look that healthy. So somebody may be very happy to say, hey, instead of a nice big profit, I'd be very happy if I get out of this breaking even. So I think I should take some of the risk off the board by locking in prices at this level, even though we may not actually be making money, okay? So again, that's the true purpose of these markets. And there's so many companies out there that use raw materials, and they need to ensure their costs going forward, because if they don't, then they don't know what their profitability is going to be. They don't know what their raw costs are going to be. So it's a big tool that most people should utilize if they're dealing with raw materials. Now, on the other side of the chart here, we have speculators. These are the fun guys. Speculators are willing to transfer risk from the manufacturers and from the suppliers to themselves. So in other words, they're not trying to evade risk. They're actually trying to pick up risk because they have a vision or a belief system that the price of something is going to go to the moon and they're going to make $1 million and they're going to retire from it. That's their business. And the idea, who cares why they do it? They don't have the product to back it. So if they're wrong, they can lose big time. With the farmers, you've got the product, so you're not really going to lose anything because you can deliver the product. With a speculator, he's only putting his money on the line and hoping that he's right. And everybody is different. And there's many, many speculators out there, whether it's in small cap stocks or in mining stocks or in the futures market, that really just have a hunch for whatever reason. Maybe their horoscope told them to buy it. I don't know. But the idea is that they do speculate and they want to try and make money. And these are the guys that you as a hedger are selling your risk to. You're getting rid of your risk. They're taking on the risk. So that's the main difference between the people in the markets. And that's the true purpose of these futures markets. Futures contracts defined. Okay, so there's a few things about futures contracts that you have to understand. First of all, they're exchange traded. That means they are traded on a legitimate exchange and that they are a legal document that is, you're not dealing with individual people. It's an exchange just like currency exchange or like the Forex or like a bank. Okay, so that's important to know that they're not just willy-nilly or they're not some guy down the road trying to sell you something. They have specific requirements. And the reason that I say that is because not everything qualifies as futures contracts. There has been in my day many, many ideas that people have come up with to make a futures contract. And there's lots of ideas. You can come up with one yourself, but it doesn't mean that they're going to work. There are certain requirements that are needed, and I'll explain in the next slide. And of course, the next thing is that they require a variety of participants. You can't just have all like-minded people there because they're not going to trade with each other. You have to have a different variety of participants with different needs. Okay, so as far as the exchange traded part, it basically means that when a future is bought or sold, the exchange that you're trading on becomes the buyer and seller of every contract. So, for example, if you're selling to the farmer down the road or if you're selling to GFO, you're dealing with us. If we buy wheat from you, we expect delivery from you. The difference with the exchange is you don't deal with an individual person or a company. When I buy a contract of corn, I have no idea who I'm buying it from. The middleman or the exchange is where it's executed. And they're almost like the playing field when you're talking about a football game. The football players play the game. The field is where they play the game. And you could look at the exchange as the playing field. The exchanges eliminate counterparty risk by taking both sides of that contract and thereby eliminating risk for individuals not being fulfilled, okay? So this gives a lot of confidence to bring buyers and sellers together on the same platform, and it enables the participants to enter and exit the market with ease because there's so much volume, so many contracts traded that it's very, very easy to get in and out. It's not like putting an ad in the paper and trying to sell something and hoping that you'll find a buyer for it. These exchanges are very liquid, and it's a matter of saying buy or sell, and as long as you're going to sell it at the current price, you could be filled instantly. That's the beauty of these markets. So, futures contract requirements. Now, again, we said that not everything requires. I remember back in the 80s when I first got into the market, they had a potatoes futures contract. And if anybody knows anything about potatoes, I don't, except that I'm allergic to them. Potatoes don't have much of a shelf life. And the idea is that they do rot and they grow eyes and they get bad. Well, the problem is it's really tough to deliver against a contract if you have a product that is decay. So it has to be non-perishable. That's one valid thing that your contract has to have. Things like wheat can be stored, corn can be stored, crude oil can be stored, gold can be stored. They're not perishable. So that is one stipulation. The other thing is that the contracts need to be standardized or fungible. That just means intertradable. When you buy wheat, you're buying wheat. When you buy gold, you buy gold. It's gold. But you can't buy a contract that has all different shapes and sizes of things with different qualities, because you'd never be able to settle the contract. Okay, so the standardization is very important. It has to be the same product that's interchangeable globally, which wheat and corn and things like this are. Now, they may up or downgrade it a bit, which is a minor thing, but it's still wheat any way you look at it. And the third point is it needs to have volatile prices. And that surprises a lot of people, but the reason you need volatility is because if you didn't have volatile prices, you wouldn't have any need for these markets. If we knew that wheat is going to stay at $5 a bushel, then we know when we grow it, we're going to get $5 a bushel. So the thing is, these markets are necessary for volatility. If you don't have volatility, it will not make a good futures contract. If we know going forward that the price doesn't move, because why would people buy and sell contracts to protect risk or take risk out of the market or try and capitalize on a gain if the prices aren't moving? So that makes perfect sense, doesn't it? And then the other thing that differentiates it from a lot of people here probably trade stocks is when you buy a stock, you basically own the stock share. And the only way you get rid of that is if you sell it or if the company is bought out. You can put it under your mattress and keep it. Futures contracts, on the other hand, have a definitive expiry date. So when I buy December corn, it means I'm buying corn that expires the contract in December. And all that really means is that I have to fulfill my obligations with that contract before it expires. And my obligations are quite simple. If I buy corn, I have two choices. I can either take delivery of that corn from whoever I bought it or wherever I bought it, or if I sold the corn, I have to deliver it. Or the second option is I can close out my position, and we call this offsetting. So the beauty of this market is I could get up this morning, see gold, say, wow, it looks like it wants to have a good move. I could buy a gold contract. 3 hours later, gold is up $3 times 100 ounces is $300. And I go, wow, I like that. I can immediately go into the market and sell my position that I bought and make $300. And I'm completely out of that market, completely out of any obligation I have, and my commitment is done. That's the beauty of these futures markets. But again, it has an expiry date. So what happens is the contract has to be fulfilled one way or another by that expiry date. So if we're dealing with corn, let's say, for example, I'll give you an example with corn. We're dealing with December corn. Basically, by the 1st of December, I need to have fulfilled my commitment, which is either take delivery of, deliver to, or close out my position. Now, we'll talk about shorting later on, but if you short corn, meaning that you're selling it expecting to go down in price, your only obligation is to buy it back. So if I sell corn for $4.30 and it goes to $4.50, that means it's moved up. I still have to buy it back. That means I lost 20 cents per bushel. But I'm out of the contract. It's that simple. It's that liquid. You can get in and out very easily. And your only obligation when you enter these contracts is to close it out. If you're in the U.S., with the U.S. markets, you could deliver against a lot of these contracts, or you could take delivery, which means if I want to actually buy gold, I can stand for delivery and say, I want my gold. At that point, when the delivery date comes, which is close to the expiry date, I would have to fund my account with the full amount of the gold, which is $1,200 an ounce times 100 ounces, which is $120,000. And when I do, when they get the $120,000, I get a warehouse receipt saying, here's where your gold is. You can go pick it up. So again, because we're not in the U.S., we don't deliver usually against. So we do use these contracts as a tool to be able to take advantage of price moves, and we can get in and out quite easily on any of these contracts. So those are basically the requirements. Again, they have to be standardized, which is fungible, exchangeable, non-perishable. They need volatility in the prices, and they do have an expiry date. Some of the participants in the market. Okay, so the exchange, as I mentioned before, is where all of this transaction takes place. The exchange does not trade. They don't get involved with trades. They don't get involved with your trades. They simply supply what it needs to set it up with the exchanges, the bookkeeping, and so on, and things like that. Okay, so that's the exchange itself. So we deal with the CBOE or the CBOT or the CME, the Mercantile Exchange. That's where the transactions all take place. If you're a broker, you also have to deal with the exchange. If you're an online account, you still deal with the exchange. That's where all the transactions are done. The clearinghouse we refer to as a settlement agency, and that is the middleman which you're dealing with. So every time you go to buy a corn contract, you buy it through the clearinghouse. The clearinghouse in turn buys it from someone else and it sells it to me. Or if I'm selling a corn contract, I would sell it through the clearinghouse, and somebody on the other side would be a matched order. It's somebody that's looking to buy it. So again, because you're not dealing with anybody else, it takes out that third-party risk. There's no risk involved. And in the 175 years of the CBOT being around, there hasn't been one single default on one single contract. That's quite an impressive statement to make. And again, that's the clearinghouse's responsibility. Speculators have a bad rap. A lot of people look at speculators and say, oh, they control the market prices. They manipulate prices. No, speculators add what we call liquidity. And I'll give you a quick example. If I'm trying to sell my Rolex watch and I put an ad in the paper, and I might find some guy that phones me and says, I see you have a watch for sale and that you want 20,000. Would you take 5? Depending how desperate I am that day, I just might. But the idea is one person phoned me and he's making me an offer. With the exchange, we have tens of thousands of people vying after the same product. If I took my watch to, okay, help me, what's the big one? Lloyd's? The big in Britain, they have but anyway, it's a big auction house. Sotheby's, sorry. If I took my watch to Sotheby's and said, look, I have a Rolex watch here, they could tell me instantly the brand, the model, and exactly what it's worth. What they would do is they would advertise to their constituents or their members and say, hey, we do have this model watch. We all know what it's worth. All of a sudden, we'd have a specialized group of people of maybe anywhere from 100 to 1,000 or 10,000 people vying after this watch. Well, guess what? If I got all of these people now knowing about my watch and they all know what it is, what's the chances of me getting a much better price for my watch? Make sense? So it's the same idea with these speculators. What happens is they're all in there looking to buy and sell. So this brings the bid ask between the two price points much, much closer. So it might be 1/4 cent. Somebody might say, I want 403.5. And the other guy goes, well, I want 403 3/4. So that brings that bid ask really tight together. So tight that I could literally go in if I want to buy the market and say, buy a corn contract. And I know I'm not going to get, I just got a cough, sorry. I know I'm not going to get filled 2 or 3 cents away from where the price is. So this is why liquidity is so important, and this is why speculators play such an important part in this market. If I only had farmers in there bidding against grains, you might get a day where there's nobody bidding. So you might only have people offering it. So can you understand, you see the difference, why the liquidity, these people that just have the common interest of buying and selling to make money, make such a big impact on these markets, okay? And then of course, the last ones are the ones that these markets, as I said before, are truly meant for. It's the hedgers. And the hedgers are here to avoid risk. And we'll go through some hedgers later on and show you them, but that's the key reason for these markets. And some of the biggest, largest companies in the world use these markets, not necessarily to make money, but to know what their costs are and to reduce risk, price risk. As us ourselves, GFO, when we buy grain from our farmer members, the minute we take possession in the form of a contract, that's now our wheat. Well, guess what? If wheat were to drop 20 cents and we have that wheat, we would be losing 20 cents a bushel. But what we do is the same thing. We buy the wheat, we hedge it in the futures market ourselves. That way, if the price drops, we're losing on the physical wheat, but we're making it in our futures contract. Okay? Okay, so the exchanges themselves, we talked about how important it is. This is a picture of an exchange. This is where all the activity takes place. They've changed over the years, as I mentioned. They used to be a lot more visual, colorful, with no electronic boards, people screaming and yelling. But now today we have what we call price matching. So it's considered the playing field, okay? They simply facilitate the trades. So to trade on this exchange, you need an account. You don't deal directly with the exchange. You either deal through a broker firm, a bank-owned firm, or you can actually go online, and there's a lot of firms today that you can open an account with and deal directly through them and actually place your own orders right online for a fraction of the cost of what it used to cost to execute an order years ago. And again, years ago when I did it, sometimes it would take a half an hour. When I put an order in, I would phone the main desk. The desk of the company would phone the floor. The floor would give it to what we call a runner. The runner would bring it to the pit. The guy in the pit would flag somebody down, try and get a price. It would go back to the runner, would go back to the phone, would go back. So it would take 20 minutes to half an hour. Today, that's not the way it is. I put an order in, it's electronic price matching. I could be filled within 2 seconds after my order's gone in, and I'll see it immediately on the screen. So it's really come a long way. Here's the clearinghouse we talked about before. And so basically, as you can see there by the picture in the middle, it's a go-between. So you got your futures buyer, right? He buys a futures contract. And on the other side, you got the guy that sells it. So even though they are two sides to every trade, there has to be a buyer for every seller, and there has to be a seller for every buyer. You don't know who they are, and it goes through the intermediate guy, and they match the prices. And the nice thing about that business is they get paid by both sides. So they act as a third party to all trades, serving as a buyer for every seller and a seller to every buyer, and they guarantee all contracts. So there's never been, as I said before, a default on these contracts. Speculators, here's the guy everybody hates. Okay, so they're basically very helpful, as we said before. Some win, some lose, but the effect is to stabilize the prices relative to what the price volatility would be without them. You got so many people bidding on the same product. That's what makes it so competitive. And since they can't participate in the cash markets, now what that means is this. People say, well, I'm going to answer a question that we already had here earlier, the one you've got here, Michael, about the speculators controlling the market. A lot of people are under the misapprehension that speculators control the price. So let me just explain how it works. If I'm a speculator and I'm speculating on the price of gold for December delivery, I can have a lot of my friends push the price of gold up if I'm that powerful and I got that many people. But once the first day of December comes, I am not allowed to play in that market. I have to either deliver my gold or take delivery. And 98% of people that play these markets never deliver or take delivery. They simply use it as a tool. So think about this. If December 1st comes and I'm a speculator and I've pushed the price of gold up, or I have to get out. What does that mean? I have to sell my gold, which has a lot of selling pressure, which pushes it down. Now, the only people allowed to trade in that cash market for that cash month are the genuine hedgers, which means that if I'm in the market buying gold for the next 3 weeks, I am buying it because I am taking delivery, or I am selling it because I am delivering to somebody. So what happens is the real players are the only ones in the market. So does it make sense that that market can be manipulated by speculators? No, it doesn't, because you're in there to buy the gold or to deliver the gold. So the speculation is completely removed, and thus the fact that the idea of them being allowed to manipulate the market is totally nonsense. They do act as risk takers. As opposed to people that want to avoid risk. They add that liquidity and they allow for true price discovery. Okay, so that's the part of the speculators. And when I was a broker, 95% of my clients were speculators. As a matter of fact, As most of you are listening, farmers know that they also speculate. Even though they're farmers themselves, they would open an account with me and they'd say they want to buy wheat. And I'm going, well, aren't you a farmer? But they still are bullish on wheat or corn or soybeans or whatever. But they do speculate as well as hedging, right? The emotional roller coaster. This is something I put in here just to give you an idea of how these markets cycle. And right now we're in one of these cycles, and see if you can identify it. So basically what happens is in the beginning, markets start to move up and you get a bit of hope, hoping that it's going to move higher. And as markets start to get higher, you get ambitious and you get excited. And then it gets to the point where you get really greedy and unexpected expectations where you think, oh, wow, we're going to see $20 beans this year. And when everybody starts thinking that way, that's generally a sign that, oh, this market's probably topped. So high hopes cause them to hold the prices way too long, and then it starts coming down. But as it comes down, he's very hopeful that it's going to go back up again. But as it continues to go lower, that hope turns into fear. Now he's very fearful that, oh, maybe it won't go back up again. And then when it gets to a point, and I'll give you an example right now, we've already seen it like with some of these commodities like wheat, is at a point where people can't really afford to sell it because it's down. And they're really concerned. But what I'd expect is before this market turns around, what you get is something that comes out that really breaks the back of this market. And it's like the last ditch attempt to say, you know what, forget it. And they just give up. It's called capitulation, where everybody just throws the towel in and says, you know what, forget it. Get me out of this market. I've had enough. I can't do it anymore. I can't sleep. And that generally is the sign of the bottom of the market. Now, I know it sounds quite simple, but believe it or not, there's so much truth to this. In every market that you see, that's generally the pattern. So the fear causes them to sell at the very bottom. And at that price, when he thinks it's never going to go up again, and that's usually the sign. Now, this market we've been in we talked about before, all the grains are in about an 8 to 12-year bear market. That means if you identified the market, you would know that continually it would make a high, make a lower low, make a high, make a lower low. And we've gotten to the point now where we're really at the bottom of this market. But before they break, generally they just do a complete nasty washout. And then that gets the last people out. And at that point, it'll not run away. It'll just stabilize and very slowly turn back up. And before you know it, in a year or two, we have a bull market on our hands. And once the market heads up, you could be looking at 2 to 5 years. These markets generally change direction no less than 2 years, but they last for many 5 to 10 years is quite comfortable for a market, as we can see right now in this bear market in the grains. Okay, so getting back to hedgers again, we're talking about most of people that are listening to this podcast and a lot of other companies. So it's for risk management, looking for cost reduction and leverage working capital. And the reason we say that, let me just see if the next slide is going to tell us. No, go back. So the cost reduction means that you can basically control the price of the lumber or the copper or the fuel oil or whatever you're trying to buy on margin, which means that you're putting up a very small amount of the money to control the price. So as opposed to having to go out and buy the product and use all your capital, we can use margin, which is usually anywhere from 3 to 5%. So it leverages your working capital, okay? So hedgers, again, that's one of the reasons. Some of the raw material hedging we look at are flour mills, home builders. And again, home builders is a big one I like to use because if anybody's bought a home recently, they know they go out to buy a home, they're going to be told that it's going to be 2 years before you get into your home. And you got to ask yourself, how can you buy a house today and pay for it, meaning commit to a price, knowing that it's not even going to be built for 2 years with the price volatility? Well, what makes that possible is today when companies like, what's his name, Gilligan, the guy from Mattamy Homes, when they sell you a home, they've already gone out 6 months or a year or 2 years to look at the futures markets and determined what the cost of things are going to be. And we'll go through an example of that in a while. Based on those projections, that's how they determine the price of what they're going to sell the product for. And they do hedge it so that if the price were to go crazy, they would make in the futures markets what they would have to pay in cash when the time came to buy the raw materials, okay? Automakers are another one. Airlines are a huge one. Think about the amount of jet fuel that airlines use day after day, hundreds of thousands of gallons of jet fuel. And that's so volatile when the prices went crazy. If an airline doesn't manage their fuel costs, they could be bankrupt inside of a week, because when the price of fuel doubles, there's no way that they can pass on those kind of costs to their patrons, because the patrons just say, forget it, I'm not flying. Or the Southwest Airlines is one of the famous ones back when oil peaked out in $149, where they were one of the few companies that actually hedged their fuel costs. And they came out smelling like a rose because they didn't have to increase their fares, and people were flocking to them because they were smart enough to hedge their prices. Because what they've done is they've taken the risk out of the market of any instability in world flow of oil or political situation in the Middle East that's volatile. Same with trucking firms, okay? As far as the supply side, that's our side. We've got farmers selling goods. We need to lock in good prices when we can, or protect against falling prices. Miners are another big one. They're digging gold and silver, copper, and that out of the mines, and need money to operate. So they hedge their positions. They sell forward contracts on the silver and gold. So if the price doesn't go above the contract, then they haven't done anything. They've protected themselves, and they don't have to give it away. But if it goes above there, of course, they just lose the extra profit on top of it. So there's so many companies out there. You can name so many. Anybody that's concerned, as I said there, with raw material price fluctuations needs to use these futures markets, because not to do it is foolhardy. Because if you don't know the cost of doing business, you don't know where your break even is. You don't know where your profitability is. Okay. And now we've talked about these markets a bit. Let's look at possibly taking a position. How does the average person take a position in these markets? All right. So again, with the farmers, we're looking at taking a position equal or opposite to the cash market. So for example, buyers of grains. Now we fit in this category. As GFO, we buy grains from our farmers. So the minute we buy it, we're at risk. So what do? We sell futures contracts. Makes sense. That way, we've locked in the price. If the price of grain drops, which it has been doing, what we're losing on our grain that we've bought from you is we're making it back equally, or just about equally, in our futures position. Likewise, buyer of grains that have to buy grains, sellers of grains, they have to go the opposite. They have to buy the futures contract because they've already sold it, and they're worried that before they deliver it, the price is going to escalate, and they got to go back and buy it. So if they're committed to deliver grains, they need to make sure the price doesn't go up. So they're completely the opposite side of the coin. Okay. Types of hedgers. So there are basically two types we talked before. So there's the long hedgers. Long hedgers, or a buying hedge. This is used to when you plan on purchasing a commodity. These are the people that are worried about their raw materials going up in price. And if their raw materials go up in price, that's going to really affect their bottom line. It's going to cause them either to lose money, go out of business, or have to raise the rates for everything that they sell. So that's their big concern. And an example of that would be someone like even simple as Tim Hortons. They buy coffee futures because they know with third world countries, anything could happen. If the price of coffee were to explode, then all of a sudden the price of coffee has to be gone up at Tim Hortons, where somebody like maybe a Starbucks that hedged it wouldn't have to raise their prices. So the long hedge are people worrying about prices going up because they use it as a raw material to produce something or to deliver it. And then the other one, as I said before, okay, so the use of raw materials, trucking companies or some, airline, home builders, coffee house, as I said before, Tim Hortons. So that's considered a long hedger. Okay, then the short hedgers is where we fall into the category again. This is the farmers, okay? So we use it as a selling hedge used when you plan on selling a commodity. The short hedge protects the seller of a commodity against falling prices, okay? Now, if it's a speculator, he's shorting it because he thinks the price is going to go down. He wants it to go down. So that's why he would short it. But as a farmer, he doesn't want the price to go down, and he wants to protect himself against falling prices. So sellers of raw materials, such as coffee growers, farmers, gold and copper miners, are concerned with the price falling. So they're considered short hedgers. The ownership of a commodity where the risk is that the price will fall. Okay, so selling futures will mitigate the risk by protecting the hedgers from a decline in the price. But again, sorry, I coughed there. I went offline. So don't forget, as Canadians, we're worried that the price is going to go down, but this is only going to be used as a tool temporarily. We cannot deliver against them. So what we're trying to do is protect ourselves temporarily until we're actually ready to deliver the product. Some of the participants, again, same thing. Okay, we've got miners, gas, oil companies, farmers, coffee growers, livestock processors, and there's just so many commodities out there today. I mean, they even have weather commodities, right? Weather futures. So the futures, they sell gold, copper, oil futures. And then the farmers, they sell coffee, cocoa, wheat, corn, beans, hogs, and the list just keeps going on and on. A sample of a short hedge. So the farmer likes the corn prices where they are, but he worries that the price is going to drop. So he may be happy with the price where it is. So he's looking at December corn futures at 340 on December the 2nd. He sells the March futures at $3.50 a bushel because he's planning on delivering sometime between December and March. So on February the 28th, before the first notice day, the March futures are now trading at 315. So what does he do? He goes in and he buys back the futures that he sold for 340 at $3.15. That means he's made a profit of 350 less the 315, or 35 cents US per bushel on the futures. So his net profit would be 35 cents times the 5,000 bushels, or $1,750 US. And that would be his profit. Now, he still owns his corn, but he's put that money in the bank, and he's not any farther behind, except that he's lower in his actual break-even cost. And don't forget, when we're dealing with these futures markets in the US, that doesn't include the basis. Okay, so the basis has to be taken into consideration, which we'll cover in a much later article. And then the other thing, of course, is the Canadian dollar, which is also part of the basis. That's a big factor as well. The long hedge is just the opposite. So somebody like a Weston Brand, I don't know if they even exist. I think I put that name in there. They want to remove the risk from the wheat price for the next 3 months. So the current May wheat futures are at $4.40 a bushel. So they buy May futures at $4.40. Come April 30th, the futures are trading at $4.80. So they sell their futures contracts at $4.80, but they bought it at $4.40, which means they have a 40-cent per bushel US profit per contract, or a net profit of $2,000 US for every contract they purchased. Sorry about that. So again, bases are not included. That's just a couple of examples, okay? Now, I guess we can continue. Before I go any on, I mean, we're getting there in time now. We're on 45 minutes in. Do we have any questions at all out there, Michael, that we can?
There's a question that's come in. Should I use short hedge to lower my break even?
Okay, I need a bit more information, but is break even on what?
Commodity, like price.
Yeah, that's not a real clear question. Depending, is he a speculator, hedger, what he's doing. So that I'd need a bit more information to know that. Do you have another one?
Can you explain the term short in the futures market?
Okay, that's a good one. Let's look at that, because a lot of people don't understand that. It's a bit confusing. When we refer to the term short, what we really mean is that a futures contract has two sides to it, okay? If I'm buying a futures contract, whether it's corn, soybeans, it means I believe it's going to go up in price. Whether I want it to go up because it's going to make me money, or if I want it to go up because it's a hedge, it doesn't matter. I'm doing this because I feel it's going to go up in price. That's called a long position in the market. The way I get out of that long position is to sell it. Now, the opposite, if I want to, let's say I'm a speculator and I figure the price of corn is going to drop, I don't buy corn. The first thing I do is I sell corn, and that's selling a contract that I don't own. So if you can get your head around that, what it generally means is it doesn't matter whether I put a buy or a sell on first. A buy and a sell and a buy still closes one, closes the other out. So if I buy first, it means I have to sell to get out of the contract. Or I have to sell first. That means I expect or hope for the market to go down in price. And by selling corn here at, say, 340, I've got until close to the expiry date to get out of my position. So if I sold it first, I am shorting that contract. Now, to get out of it, I'm not going long. What I'm doing is closing it out. So again, if I buy it first, I'm long. And to close it out, I sell it. But if I anticipate or I need it to go down or I need protection and I want to sell it, I can sell corn at 340 and all I have to do is buy it back. But when I sell it at 340 first, I've shorted the contract. And then to get out of it, I buy it back. Now, it may go the wrong way. It doesn't matter. If I short the contract at 340 and it goes to 350, I'm losing money, but I still have to close it out, which means I buy it back. So a short, you buy back. A long, you sell. If you put the position on first to short it, it means you sold it first, and your obligation is to buy it back. Does that make sense? I hope so. So what do you think? Should we continue, do you think, or are we 50 minutes in? We got a bit here to cover over the next one. So I think possibly maybe we're 50 minutes, and we probably should leave this part for the next session unless we have any more questions. We got one more here. Oh, yes. Okay. No, we'll save this one for the last, talking about futures brokers. We'll get into that on this one on trading accounts. So I guess our plan is 2 weeks from now, we'll be back and we'll be covering a couple of more sessions on futures. And then hopefully the very next session after that, we will be looking at starting into options. So thank you folks for coming. Thanks, Michael. Thanks, Megan. It's been fun. And if you got any questions, you can email us. You can email me at mhibbs@gfo.ca that you didn't understand. But we hope that you enjoyed the session. And until next time, have a great day. Thank you.